Good morning, it's Harvey Jackson. Just going to get a little bit of information on the inflation data and how it puts rate moves in question. Uh, we'll just get into it.
Canada says the annual rate of inflation cooled in July to 1.7%, down from 1.9% in June. Lower pump prices were to thank for the decline as gas prices dropped 16% year over year in July because of the removal of the consumer carbon price. However, the cost of groceries and housing rose. StatCan says the grocery category was up 3.4% from 2.8% in June, driven by higher prices for cocoa, coffee, and fresh grapes. Shelter inflation also saw its first increase since February of last year as rent prices rose. While the headline inflation number eased, core inflation metrics, which the Bank of Canada has been paying more attention to recently, are still stubbornly high, hovering around 3%. That's why economists appear split on whether the latest report is enough for the Bank of Canada to cut interest rates at its next meeting in mid-September after 3 straight holds at 2.75%. The central bank will get one more inflation reading the day before its meeting next month. Canada said
So you can see here the just a graphic that's showing your differences between the inflation rate and your uh, policy rate. So your policy rate has been steady for the last little wee bit here, but the inflation is right around that 2%, and the numbers that they're using to launch whether they need to do something for cutting and stuff like that is different than it was when the markets were really high. UK inflation rises as well, so they've got some questions and cutting rates there as well. And here, this is more on the Fed, so this is the U.S. side.
The Fed's preferred measure of inflation, right? The PCE, personal consumption expenditures. And we sort of have the inputs, right? We sort of know around where that number is going to be. What does your analysis show for that? And then how's that going to feed into what the Fed will do?
Yeah, so that's feeding into our view that the Fed's not going to cut in September because inflation, while again, it's not showing all of this pass through, it's not as alarming as it could have been from tariffs. Well, you're still looking at something like a 0.3% month-over-month increase in core PCE. That's well above the run rate the Fed needs to hit. They need something closer to 17 basis points, so you're missing that by a decent margin. And we have core PCE actually moving up to 2.9% year over year from 2.8% year over year. So you're now 90 basis points above your preferred target of 2%. And really, the direction of travel points towards more upward pressure, not less coming, again, because we still have more tariffs in the pipeline. So for us, we think the Fed really needs to be concerned about their inflation side of the mandate, and they need to exhibit that concern by not cutting rates in September.
So if that is the message that we're going to hear from Powell on Friday, potentially, which would be in keeping with what we have heard from him, I mean, that's going to be quite a shock for this market, is it not? Because it seems like there is, if not consensus among economists, it seems like there is more consensus among market participants and what's being priced in.
Absolutely. So the market, last I checked, was something like 80% chance of a 25 basis point cut in September. It might be a little bit higher. It's moved around here and there, but it's definitely, pointing towards a very strong likelihood. And if Powell's really more 50-50, you probably want to get that pricing down closer to 50-50. If he wants to wait to see that employment report in early September, then you want to get market pricing a little bit more equal or evenly distributed between cut or no cut. So one way he can do that, of course, is giving a bit of a hawkish message. He doesn't have to fully dismiss that the labor market has softened, that we did get that jobs report, but he can emphasize
sorry. So the U.S. Allows emergency authorizations of animal drugs to fight screwworms, and this is important. Why? Because just the understanding that the market does want to prevent any screwworm entering into the U.S., and they're going to use all measures, especially with the price of beef where it is. But they need to get beef from Mexico into the country, because it's very inflationary. Especially when you're buying beef, you basically have to go on. It's either you choose a holiday or you buy beef. Here's another tidbit of information that just came out as well. Just talking about Japan and South Korea. They're concerned about the long-time American security guarantees. So they're actually looking at the nuclear arms. The longer it takes for the focus of tariffs with all the other countries, U.S., because U.S. provides all the security guarantees, and they're just wondering if this is going to happen. So let's just have a quick look at the weather here. Manitoba, you can see that there's some dry pockets there, and you can see right where I live there, that's pretty dry there as well. So harvest can go along pretty quick if we can get the right weather. It is quite dry though. And you can see here the soil moisture is even showing probably closer to optimum, but that's just based on different kinds of soil that's throughout the Manitoba as well. It's all black soil, but there's even just some that can hold moisture better. Total soil moisture, it's running in that 25% in the deep red, and a lot of pink, that's 25 to 650. And those showers actually really improved. I'm going to say the northeast Saskatchewan into Manitoba as well. Here's just a quick look at soil moisture as a percent of normal. You can see that there's definitely areas that are deficient, and you can see, Calgary actually ended up with a big move, like it's 200% over normal. Here's just a quick overview of when the rain is going to come and how much. It is it looks like the south, or a lot of the prairies are going to be without rain, so hopefully that can actually allow harvest to come along. Same thing with the GFS, but it's showing a little bit more precipitation in Manitoba here. Just have a quick look at the markets here. Canola down and rapeseed down. Soybean oil is down. Crude palm oil is up slightly. Soybeans basically flat, and you've got your wheats on both sides. The Kansas is the one that's down, and the other two are holding on. So if we look at canola, it's not getting really oversold or anything like that, but we did pass the 200-day moving average and the 38.2. So now we're into that range of the approaching the 23.6 retracement value, which would give us a kind of like targets at 620 as a probably a hold, 600 just because you're switching numbers, and then 580. So every $20 from where we are basically downward is going to have some sort of hopefully some support on canola. Here's your European rapeseed. It's trading down a little wee bit, so the short-term moving average, it's actually below it, and approaching the 23.6 retracement value. The valuation of the European canola versus canola is $116 right now. So European rapeseed is $116 more expensive. So when you look at this, this is your soybean oil futures, and that's been on its way down. It's trading below all the moving averages, and it looks like it's going to try to get back to that 61.8, and need another little bit of a leg to fill in that gap. So it needs to get down to very close to the 50 cents. So this could be bullish or bearish. The soybean futures here in November, this could be a bull flag, but as I pointed out yesterday, that spinning top is a bearish signal. So which one is it going to, or how is it going to perform? I'm leaning a little bit to this side of downward move on soybeans. So if you haven't got your soybeans sold at 12 or better on futures and getting into that 25 to whatever your comfortable percentage sold, I would be looking at trying to capture some of those markets. Soybean meal futures looks like it's going to try to approach this 300 short ton value, and it looks like it's maybe having a little bit of resistance there. Palm oil, it's bumping its head up against some of those previous highs, but that's going all the way back to February. Downward trajectory just for crude oil still in place. Canadian dollar looks like it's downward trajectory there as well. So when you look at the US dollar futures, it's kind of just chopping along, going sideways here. Wheat, still looking for some technical signals to buy spring wheat here. Still nothing showing up, even though we've got a green day. It's hard to pick a bottom, but there's no signal to pick a bottom here or buy the bottom yet, because your Kansas and your Chicago are both making new lows every day here, it seems. Even though your Chicago corn, it made a low last week, but it's still in this downward channel going down here. And that's all I have for you today.